Hello and welcome. You're watching an NDTV Profit special on India's current account balance surplus. Now, India's current account balance has recorded a surplus for the first time in 10 quarters. This is for January-March 2024 quarter. Now, the balance recorded a surplus of $5.7 billion. That's about 0.6% of the GDP in Q4, and that's compared to a deficit of about $8.7 billion or about 1% of the GDP in the preceding quarter. This was largely on the back of lower merchandise trade deficit as well as stronger services exports. Now, for the full year as well, the current account deficit has moderated to about $23.2 billion or about 0.7% of the GDP. But the expectation is that we're likely to see a deficit once again for the ongoing quarter. But to share more details with me on that, I'm joined by Aditi Nair, Chief Economist at ICRA. Aditi, thank you so much for taking time out.
Thank you, Pallavi.
So, just help us put this in perspective. The last time that the Indian economy did see a surplus was because of COVID and the impact that had on merchandise trade. This time around, this is despite a resilient economy and on the back of course, strong exports, merchandise as well as services. So how do you view it?
So, Pallavi, certainly we've got a very good set of numbers yesterday that have come in for the current account balance. We were expecting a very mild surplus, so the size of the surplus has exceeded our expectations for this quarter. Now, as you said, it's coming on the back of higher services trade surplus, and I think this is structurally a very big improvement that has happened for India's current account scenario in terms of the kind of inflows we're seeing related to the GCCs over the last several quarters. And also merchandise exports have been strong, but what has really helped is that commodity prices for a large part of FY24 were much lower than they were in FY23. Now, in terms of the surplus itself, while it's certainly welcome, we expect it to be transient, and we do expect that the Indian economy will revert back into a modest current account deficit from this quarter onwards. The data that we have for April and May is tracking higher merchandise trade deficits than the year ago level on the back of now higher commodity prices. Broadly, I would expect that we're going to, run a very mild current account deficit about 1 to 1.2% of GDP in FY25. And for the first 3 quarters, we're looking at absolute numbers of between about 11 and $14 billion each, and a much smaller current account deficit in Q4, which is traditionally the case.
Okay, all right. So talking a little bit more about the current account deficit that's expected for FY25 as well as across most of the quarters. So that's approximately about 1% to 1.5% of the GDP. Is that right?
So for the year as a whole, we're expecting a current account deficit of 1 to 1.2% of GDP. And this is broadly building in crude oil at an average price of $85 per barrel over the full course of the year.
Okay, I do want to understand what is going to be the likely impact of the funds from the bond inclusion on the balance of payments. Does that bode well for the balance of payments and also for the rupee? What is your outlook in the next few months?
So that will come in on the financing side and will certainly take care of a large part of the financing of this very modest current account deficit that we're expecting in FY25. For the rupee, possibly part of this year, there's going to be more of a tendency towards appreciation rather than a tendency towards depreciation as we saw over the last year. And overall, I would expect that the rupee is going to remain relatively stable in a narrow band in FY25 as well.
Okay, Aditi, I do want to ask you about the FDI flows. So while FDI inflows have not changed much, we did see higher outflows and that does show up in our external metrics as well as at this point. Is that something that you are concerned by, and what is the outlook going forward in terms of FDI?
See, on FDI, there are multiple factors that influence the kind of numbers that we get in any particular year. what is the domestic situation, how positive global investors are on India and on, both on the size of the Indian market as well as the competitiveness to export from the Indian market, as well as really what's happening with sentiment globally. So it's a confluence of a lot of factors that come together to determine the kind of FDI inflows we get year after year. I would imagine that FY25 will be a little better than FY24, and possibly going forward, we do think that FDI will strengthen going forward.
Okay, all right. And, we did talk about merchandise trade and what's broadly the outlook, but I do want to understand, given that we have spoken about how the trade deficit is, the current account balance is expected to revert to a deficit largely on the back of improving demand as well as commodity prices. But how are you viewing exports and what's the outlook for FY25? We did see some sort of weakness in exports temporarily, and we're once again seeing stronger figures, presumably on the back of stronger global demand. Is that something that you expect will sustain for FY25 on merchandise exports?
So I think it's a combination both of slightly improved global demand as well as higher commodity prices, which are seeping into the better merchandise export numbers that we've seen in the last few months. And I think that is basically the trend that we're expecting for FY25 as well. Broad rule of thumb for the year, merchandise imports growth should be higher than merchandise exports growth, because import demand should be better than global demand, given where we are in our demographics, etc. And secondly, while I expect the pace of growth of services exports to start coming down from the very high levels that we've seen, already that trend had started in FY24, and we expect the pace of growth of services exports to moderate further on a growing and a fairly large base now. So in FY25 as well, we expect that to continue, but possibly service exports growth will continue to outpace merchandise exports.
All right. Thank you so much for taking time out for us, Aditi. That was extremely helpful. Thank you for joining us.
Thank you.